The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, right now here on the program, always enjoy a conversation looking broadly at not just the markets, but the ag economy in general. And joining us for that conversation, one of our friends of the show, David Widmar with Agricultural Economic Insights, joins us here today. David, it is good to catch up with you again, my friend. I hope all is well with you.
Yeah, great to connect, Jesse. Looking forward to today's conversation.
Well, let's start with the big topic, I think, amongst farmers and ranchers right now is commodity prices, livestock prices, et cetera, especially on the grain side. We've seen this downtrend here as we work through the summer months. We're starting to get a fairly good handle on what the size of production is going to look like this year. I know you've written some very interesting articles lately on the AEI website, the premium side as well. Talk about, because I know we got a WASDE report coming up here next week. Monday, we got a report coming up. Quarter beans, ending stocks, prices, etc. You got an article about this on the AEI website. Talk about some of that relationship between ending stocks and prices. Let's start there.
Well, I think the first thing to keep in mind is it's still very early for this 24-25 marketing year. It technically hasn't started, but the reality is we started the growing season with favorable, not really favorable, but break even, survivable crop budgets. And then the commodity markets have really fallen out. The floor's fallen out on us. And so we're sort of figuring out where are we going to end up at. And so what we try to look at is stocks to use, historic market year average prices. Where does this come together? So I think one of the reliefs that producers can take if they're reading this article is that the USDA's estimate for those market year average prices they put in those WASDE tables is largely in line with where the stocks to use are for where we're currently projected. Now, the uncertainty here is where this crop is going to come in at. And one of the caveats from this report is that we haven't had a corn crop above 16% stocks to use in the last 14 years, going back to 2010. So that might lead us to say that $4 market year average price is the floor. But if we zoomed out, there have been years, between 2000 and 2010 where we had 17 and 19% stocks to use for corn, and that results in a much lower price. So I think the markets are trying to figure out where these crops going to come in at. We're sort of talking about maybe a trend normal or above trend yield for the first time in a long time. So we got to figure all this out. And ultimately producers have to realize, start to think about how much cost cutting that they have to do for 2025.
Well, and think about this as well, and it's something that we've talked about before. It's that supply versus demand issue here as well that's got to factor in. And, realistically, the demand has not been overly abundant, I guess, for U.S. commodities, whether it be for this old marketing year that's getting ready to wrap up or this new crop marketing year as well. Both sides of that coin, demand hasn't been robust. It's been there in increments, but it hasn't been expansive, I guess, is the way I would put it, David.
Yes. The way that we look at this, and I think there could kind of be a debate here, and I think it depends on how you look at the data. One way of looking at the data is looking at absolute bushels and saying, is this a high number or a small number over the last 5 or 10 years? I think a better way of looking at this is trend lining it like we might with yield. We see a pretty statistically significant trend line that plays out over several decades. And when you look at that departure from the trend line usage, like you said, Jesse, it's been below. And we're going to have to see record volumes to get back to that trend line. And given, 14, 15 stocks percent to use for corn over the last couple of years, we want to see even above that trend line. I think the question that we have to, think about is where this is going to come from, especially on the corn side. It's probably going to be a lot of export activity that's going to need to kick in to make this happen. Soybeans might have a little better situation where we have this domestic demand that could still be strong. And then if you layer in uptick in maybe export activity, that could be helpful. But, there's just a lot of things going on. And if anything, this week reminded us about it's the importance of exchange rates.
Very, very true. I mean, thinking about just that overall economic picture, and I'll ask you about this real quick before we go into another piece of this puzzle I wanted to ask you about. But man, oh man, tumultuous week in stocks, a lot of global financial uncertainty out there, and you mentioned exchange rates and everything else. Just a volatile week here this past week across the stocks, banking sector, financial sector as well. And it's interesting how all of that permeates its way into the ag space as well, David.
I think one of the lessons here that producers can take back to the farm is we saw this week that there were some behaviors that were, based on some assumptions that were accurate for the last 5, 10 plus years. There's a set of assumptions that were working, and people were using that to a big degree with this exchange rate carry. I think the lesson here is, what are we doing on the farm that has maybe worked in a low interest rate environment between 2010 and 2022 that we need to reevaluate those assumptions for in light of higher interest rate environment, leaner profits coming up, maybe the proverbial cost tightening going to be happening here in 2025. We've got to trim our costs lower. And so I think this is, another reflection that we just need to recognize that it's not business as usual. We need to sort of put a new set of glasses or a new set of goggles on as we think about the year ahead of us.
You had another article on the AEI website as well, and I thought this was interesting. I'd love for you to talk about this a little bit too, because I think this goes well with what we've been talking about so far. Real ag commodity price. And I know you guys looked at a couple decades worth of data here. What exactly are you talking about when it comes to real ag commodity price? Explain that for us a little bit.
So the idea is adjusting. So by real, we mean inflation adjusted ag commodity prices. And what we did is we looked back at prices all the way back since 1950, and we adjusted them for inflation. And one of the things that you notice when you start to do this, and we looked at it for corn, soybeans, and wheat, is that inflation adjusted commodity prices trend lower over time. And that's just an important sort of reality that we have to think about is this is what's going on. So one of the things we were curious about is which one of these commodities sort of had the slowest rate of decline. And interestingly, it was soybeans. And wheat had one of the fastest rates of decline over this period. And so the takeaway here is that we kind of need to get used to this idea that the last several years have been high commodity prices relative to that downward trend that we've talked about. So we've been in a favorable price environment. Another lesson from that data is that you can have long periods of agriculture where commodity prices are really high or really low relative to each other. So I think you got to be prepared for both of those. And I think the last piece is that we sometimes get caught up or excited about this increase in commodity yields over time. And when we looked at this for corn, so took real annual prices and observed yields, and you multiply those together and say, what's the real revenue or the inflation adjusted revenue situation look like for corn over several decades? It's pretty darn flat. And so what this tells us is that producers are going to be sort of keeping up with inflation, with downward commodity prices in inflation adjusted terms, upward yield trends over time. And so we just need to sort of think about that as we think about our business and growing it and how we're going to plan for growth in the future. Oftentimes, producers need to plan on expansion to grow their business, to bring the next generation on, to support maybe a higher family living expense. And so we need to think about that. We can't necessarily plan on high commodity prices and high revenue to be a source of growth for our business for long periods of time.
It's kind of interesting to look back at the past and look back at data to be a piece of making decisions moving forward. Because to your points, you alluded to it a couple of times here. Looking at 2025, it's going to be an interesting year with plenty of adjustments on the farm and ranch here, David, as we try to move into a new year.
I think one of the key things to think about with respect to this inflation adjusted piece is that, are we going to see farm prices get below $4 a bushel and stay there for a long period of time, like we had in 2015, 16, 17, 18, 19. And maybe the answer to that is yes, but we have to realize that $4 corn 5 years ago and $4 corn today have very different purchase prices. And same with $6 corn. $6 corn that we had 2 years ago and $6 corn we had 10 years ago had very different purchasing prices, especially as we think about the implications for family living expense or maybe our debt service obligations. So that's don't get too anchored on these nominal prices, because inflation adjusted prices are really important, especially over several years.
We are talking with David Widmar from Agricultural Economic Insights here today on the program. David, let's talk a little more broadly about this ag economy. And I noticed an article as well, another article you had on the AEI.ag website, looking at farm liquidity. And I had seen this news as well, that non-real estate loan activity had jumped up a bit. I've been hearing a lot of comments from ag bankers. They're sounding the warning sign, so to speak. Some are saying we're at the edge of a cliff, even. They're using that term. What's your feeling on this overall farm liquidity picture, ag economic picture, et cetera? Give us some of your thoughts there, David.
So yeah, let's back up and talk about liquidity and what that means. So it's a balance sheet measure. The idea here is, what are the current assets that farms have? So current assets are those assets they can convert to cash in the next year. So it's grain, it's livestock they plan on selling, it's prepaid expenses, and cash and savings. And we subtract off our current liabilities. What are the bills that we have to pay? What are the account payables that we have over the next year? And so working capital is a liquidity measure. We've kind of talked about this in earlier episodes. And the idea here is working capital did not recover at the farm sector as much as it didn't recover to levels that we saw back in 2011, 12, and 13. Despite having record high net farm income in 2022, we saw an increase, but it didn't increase as much. So why did that not be the case? Well, not every farm had a good year in 2022. There's regional impacts. And I also think that, there was a lot of things that we were buying in 2022, equipment or maybe farmland that required, we wanted to use our cash, or we needed our cash to make down payments. So that was the first sort of level of concern that we had, several months ago. The latest data, as you mentioned, is an uptick in our use across the farm sector of short-term debt. So when we're thinking about operating lines of credit in Q1 and even in parts of Q2, we saw the banks reporting more demand, more use of these operating lines of credit. Now, keep in mind, we had really low levels of utilization because of the high profitability a couple of years ago. We haven't got back to levels that we saw, before 2020 or back in 2018 and 2019. So we're kind of between these two levels, but the trend has been farms are sort of maybe getting to a working capital situation where they don't have enough working capital on their farm, so they're starting to turn to lenders to make sure they can meet all those obligations. And the idea here is that it's time for producers to update their crop budgets given the new commodity prices, and that's really important to know where you stand in this environment. Update your working capital projections. Think about how much what your cash flow needs are going to be over the next 6, 8, 12 months. And then also start thinking about how you're going to weather maybe this margin squeeze and these cash flow crunches. Working capital is the frontline defense. Oftentimes, the second layer here is working with lenders to figure out how we can use debt to help us meet all of our obligations. I think what's really important here to keep in mind is that we have a lot of risk management tools, but there is no risk management tools that covers every scenario. And we're getting into a situation where, for example, crop insurance, it's a great risk management tool, but it doesn't necessarily help in situations like we're going through, which is this margin squeeze. Several years of declining commodity prices, tight or negative returns at the farm level, and working capital burning of working capital to meet all of our obligations. That's going to require more financial tools to get us through that.
Very, very true. And you think about where crop insurance is at. FSA's updated some of their loan programs. That's been in the news here as of late. There are a lot of tools in the toolbox. I think about this a little more broadly as well, with all of the ag companies with the losses they're showing for revenue and earnings, and the layoffs we've seen with Deere, for instance, things like that. I think that all adds a layer of uncertainty to farmers and ranchers across the country when they look at their overall economic picture and their liquidity picture. Would you say? Would you agree with that? That maybe some of the ag business side is maybe adding that extra layer to what farmers and ranchers are thinking about right now?
Well, it's definitely getting headlines. It's sort of bad news, and it's kind of reflection of those bad news. Is I think there's sort of two things that every ag business and every producer and every consumer of this content and these ideas need to keep in mind. There are the underlying earnings that are going on. So that's the earnings at the agribusiness, or it's the earnings at the farm level, it's the earnings at the farm economy. And this has been sort of trending lower. The other piece here that's adding a lot of challenge, and I guess those earnings are what drives some of these liquidity and cash flow challenges. The other issue that I think folks are facing in agriculture and the broader economy is the rising interest rate environment. So if you have an acre of farmland or a share of a company, for any given level of income, when we have higher or raising interest rates, we're going to price assets at a lower level given that earning opportunity. And so the farm economy, I think, especially for farmland, and we didn't even get into farmland today, it's going to be a whole nother topic that we're seeing more data coming through. But I think heading into 2025, we have to navigate two of these hurdles. It's the income slip and it's the rising interest rate environment. So we're going to be using more debt. That's an expense, but also the interest environment with respect to asset values. And that's going to be really key to navigate. We didn't have this crunch of rising interest rates the last margin squeeze 10 years ago. And we've been looking at this in some of our work and stuff. So it's, yes, it's higher operating costs, but it's also the impact on asset values. And that's been important throughout the farm economy, the broad economy as well.
Very interesting insights, and it's something we're going to have to watch as we go through the rest of the year. I do want to ask you as well. I know you had an article looking at direct farm payments and talking about the Farm Bill, and obviously the Farm Bill is still something that is being widely talked about. There's maybe some Farm Bill fatigue out there in general because we don't have a new one yet. We don't expect a new one now, probably until next year. What did you find when you were looking at some of the numbers in the Farm Bill and some of the different things you've been studying there, David?
Well, we're in a very interesting situation in the Farm Bill. I don't think anybody would have predicted this when we signed that 2018 Farm Bill. We have a scenario here where there are basically two categories of payments being made to producers in 23 and even into 2024. It's conservation. If you look back through history, it's a pretty stable program year in and year out. It's $4 to $5 billion annually. And conservation is a big part of that. The CRP program is a big part of that conservation program. And the other one is the other major payment, the direct payment that producers are receiving is ad hoc programs. And so we've had ad hoc program after ad hoc program. This has really been the ad hoc farm bill from 2018 to 2024. The majority of payments, again in 2024, are going to be ad hoc. And this means Congress is passing, or the executive branch is using other programs to funnel money to producers that isn't been authorized by the Farm Bill. And this is really important to recognize, is that we're sort of getting these direct payments to producers coming in through conservation or ad hoc programs. And this has been a trend over the last several years. And they're making up the majority of all the payments here. We haven't seen a lot out of the ARC and PLC program. We haven't seen much out of other Farm Bill Title I type programs. So it's been these ad hocs. The other thing to keep in mind is that we had record high, all-time inflation adjusted direct farm payments in 2020. And now we're at some of the lowest levels in a generation. So if we didn't have those ad hoc programs, it would be even smaller direct payments going to producers. And so again, the Farm Bill is also challenging, struggling with this Farm Bill, or this farm economy uncertainty. The safety nets didn't get raised fast enough to make big payments in this commodity price environment. That's going to be a challenge for producers. But if these low commodity prices persist, then the farm bill could be on the hook for large payments, in the next few years. I think that's what makes this farm bill so difficult to negotiate, is the potential for big payments in the future, just not payments today.
Awesome stuff, as always. Give us a plug real quick for the website. You guys have a ton of information on the free and the premium side. Where can folks get more information, David?
Follow us at aei.ag. You can sign up for our free Monday newsletter, and there's always an article out there that's available to all of our followers and readers. And of course, there's AEI Premium, and we're also on all the social medias, Agricultural Economic Insights.
Agricultural Economic Insights, AEI.ag for more. David Widmar, always good to talk with you, sir. Thanks for joining us today. Appreciate it.
Thank you.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.